Hello out there. Welcome to session number 8, Cash Management Institutional Charges. Thank you for joining us today. My name is David Musser. I'm with Federal Student Aid in the Policy Liaison and Implementation Office. And my co-presenter today is Greg Martin from the Office of Post-Secondary Education. So this session is related specifically to institutional charges, but there are a lot of questions that you guys might have that are more general about cash management. If you're interested in those kinds of questions, especially things to do with disbursements, I would recommend taking a look at session number 1, Administering Disbursements. Unfortunately, we don't have any more of those sessions here at the conference this year, but you can always download that presentation at fsaconferences.ed.gov and listen to the recording of that session if you're interested. But we're focusing today on institutional charges and their application in various contexts, including return of Title IV, including proration of tuition and fees, and a number of other areas. So with that, I will get started. So our agenda today is going to cover a number of different areas. First, we're going to address what an institutional charge is, how we define institutional charges. We're going to look at the categories for various charges, including non-institutional charges and excludable charges. We're going to look at how institutional charges play into the return of Title IV calculation. We're going to look at books and supplies and whether they might be treated as institutional charges, and if so, the consequences for your administration of Title IV aid. We're going to look at crediting a student's account and how Title IV credit balances work with institutional charges. We're going to look at how you prorate institutional charges, and then we're going to point you to some resources for your questions about institutional charges and how many of these processes work. And then we're going to have some time for questions and answers at the end of our presentation. So the first thing that we want to discuss is pretty general. Let's start out simple. What is an institutional charge? So it sounds vague, but the department actually has a pretty specific definition for what an institutional charge is. And really, there's basically just two categories. There's institutional charges and there's non-institutional charges. So we consider an institutional charge generally to be tuition and fees and room and board if you contract the room and board and it's not simply a pass-through situation where you're adding to the student's ledger as a convenience the charge for some other company that is working with your room and board, and other educational expenses that are paid to the school directly. But we also treat as institutional charges expenses for required course materials if a student does not have a real and reasonable opportunity to purchase those course materials elsewhere. And so we're going to talk a lot more about this as we go through the presentation, but these are two important categories of institutional charges as the department defines them. So why are institutional charges important? Why do you need to know what an institutional charge is for your administration of Title IV aid? There are several important applications of institutional charges. They affect the amount of Title IV aid that you're required to return as part of the R2T4 process. So that's probably the way that many of you are familiar with institutional charges is they are part of the R2T4 calculation, and they in fact limit the amount that the institutions are required to return when a student withdraws. But institutional charges also impact whether schools are required to prorate charges for when you charge for longer than a payment period. So for example, if you charge for an entire academic year, then you have to prorate the amount that you provide to the student for a given payment period when you're determining what the student's credit balances are. We're going to talk a lot about that a little bit later in the session. And finally, it determines whether the institutions are subject to requirements for allowing students to opt out of your systems for providing books and supplies, and treatment of those books and supplies, and specifically whether we treat those books and supplies as part of your tuition and fees, which results in a number of different requirements. So these are the reasons that you need to know what institutional charges are in order to know whether any of these requirements might apply. So the department has some basic principles for institutional charges that we set out in a policy bulletin back in 1999. These are still the basic ideas behind institutional charges, and you can always reference that document on IFAP, on the Information for Financial Aid Professionals website. But basically, all charges for tuition and fees, room and board, and other charges assessed are institutional charges unless you demonstrate otherwise. So if you're going to treat a charge as a non-institutional charge, you need to demonstrate why it's not a non-institutional charge. And we are going to get into the categories of charges that are non-institutional. But it's important that you show why they're not institutional, because if you don't, your auditor may assume that they're institutional, and they may hold you accountable for that. An institutional charge does not necessarily need to be assessed to all students. So there could be some charges that some students incur and others don't incur. So that's an important consideration. And finally, institutional charges may or may not be charged to a student's account, and not all charges on a student's account are institutional charges. So if you have non-institutional charges, for example, like athletic fees, certain discretionary fees like library fines, things like that, those may be on the student's account, but they won't be institutional charges. So if they fall into that category, you'll need to identify them and sort of pull them out of any place that you're including institutional charges. So there are also some limitations on institutional charges, specifically on how you can charge students in some very limited circumstances. And just as a disclaimer, that in general, the department does not regulate how you charge students, but these are two very specific exceptions to that rule that apply when you have institutional charges for students. So the first one is a restriction on how you discount tuition. You can't have a system for discounting tuition that results in Title IV recipients being charged a greater amount than what other students who don't receive aid are charged. And this is really aiming at cases where, for example, an institution charges, let's say, $10,000 normally, but it also gives a $5,000 discount to cash payers, people who pay up front and are able to pay at the beginning of the term. So because in the vast majority of cases, students who pay up front are not going to be Title IV recipients, we would treat that as a situation where you're charging Title IV recipients and non-Title IV recipients different amounts, and that's prohibited under our rules. So the second type of prohibited charges are overtime charges, and these are charges that the school makes for a student who fails to complete their academic program within the normal time frame. The most common place that we see these are in certain clock hour programs, where a student has a specific time frame where they're expected to complete their program, but after that, the student incurs additional charges. The department we don't prevent you from charging a student overtime charges, so that's a little different from the discounting system that I just mentioned. You're prohibited from discounting and treating Title IV recipients differently from non-Title IV recipients, but you can make overtime charges, but you can't include them when determining student Title IV credit balances. So that means that if you do have overtime charges, it can create a lot of complexity because you're going to have to exclude those from a student's ledger account when determining whether the student is eligible for a Title IV credit balance. So it's just something to keep in mind. These are the exceptions to the department's rules on essentially not regulating how you charge students and how you assess tuition. So there's basically three types of institutional charges that we're going to talk about today. I've already talked about general rules for institutional charges, but there are also non-institutional charges. There's a bunch of categories of charges that the department treats as non-institutional. And there are also a very small number of charges which we consider to be institutional, but which you can exclude from the RTT4 calculation. And we'll talk about those in a second as well. So now let's talk about non-institutional charges. And this is probably the most important thing to keep in mind from this part of the presentation, because these are the types of charges that you will have to document and omit from your overall charges. So we've got a number of categories of non-institutional charges. The first one is charges for required course materials, where you can demonstrate students have a real and reasonable opportunity to purchase the materials elsewhere. So there are lots of places where this might come up. As long as you can show that the student had the ability to purchase the materials from somewhere other than the institution or one of its affiliates, then this will probably apply. So in most cases, books and supplies are going to fall into this non-institutional charge category. Another type of non-institutional charge are charges to a student's account for room charges that are collected by the institution but passed through to an unaffiliated entity. So that's what I was mentioning before, cases where you're working with a company that's providing the room and board, but you have really no relationship with that company except that as a convenience, you're putting their charges on the student's account and allowing Title IV aid to pay for those charges. In those very limited circumstances, those might be non-institutional charges. We also consider charges to a student's account for health insurance fees to be non-institutional in a couple of really specific circumstances. If the insurance is required for all students, and if the coverage remains in effect for the entire period, even if the student withdraws. And this is essentially because we want to allow for college health insurance plans, but we don't want to treat those plans as if the student no longer qualifies for them. We're essentially treating them as a benefit to the student that extends beyond their attendance. So as long as those two conditions are met, health insurance fees are non-institutional charges that you would not include in your R2T4 calculation, for example. And finally, charges to a student's account for discretionary educationally related expenses, so athletic tickets, concert tickets, parking or library fines, etc. I realized a second ago I said athletic fees. Athletic fees are often charged to all students and they're applicable to everyone. Those are probably institutional charges. But if students are buying one-off tickets to athletic events, those are probably discretionary charges that are non-institutional. So even if they end up on the student's account, and that's a common practice at a lot of institutions, those are non-institutional charges that you would not, for example, include in the R2T4 calculation. Okay. So we talked a lot, I've mentioned this a couple of times, and we're going to spend some more time on it here. So what is a real and reasonable opportunity for a student to obtain books and supplies elsewhere? And as I mentioned, you can treat books and supplies and other materials as non-institutional charges if a student has a real and reasonable opportunity to purchase them from a place other than the school or one of its affiliates. So alternative sources include two things. Convenient locations, so these are physical locations that you know that students have access to either on or near the campus, and online providers that are unaffiliated with your school. This second point is something you may not have heard because this is relatively new guidance that the department gave back in March in our electronic announcement. So if you can show that the materials, the books and supplies are available on online, on a provider online, and the obvious example that I'm thinking of, and I'm not making any kind of advertisement here, but for example, Amazon or another provider where they can get books. There's a lot of textbook providers out there. Any of those things would count as a real and reasonable opportunity for students to obtain the books and supplies, as long as you can show that the books are available there. So you have to demonstrate a number of things to show that a student has a real and reasonable opportunity. So you have to document that they were conveniently available from either a physical location nearby or an online location. You can't restrict the availability of financial aid funds to purchase the materials. So for example, you can't just wait until the end of the term to disperse Title IV aid to your students. I know most of you probably wouldn't do that, but there have been a limited number of cases where schools have done that, and in those cases, because the students don't have access to their Title IV credit balances, a lot of times they don't have the ability to purchase materials with those credit balances. This is an older rule that came up in 1999 and almost never applies anymore because of the regulation that the department created that requires you to make all books and supplies available to students if they have a credit balance available. But it's still part of the department's general policy, so we are mentioning it here. And finally, a school can't maintain practices, so for example, mandatory book vouchers that are only good at a school's bookstore, that discourage or prevent the student from purchasing materials from another vendor. So there's an important word here, and it's the word mandatory. So this would only apply if the school gives the student no choice. It automatically credits the student or debits the student's account for the amount of the stipend that it's going to give them for the bookstore. The student can't turn it down. There's really no way for them to do that. You do have to have an opt-out in any event when you have this system. But let's just say that the school basically requires everyone to do this and only has an opt-out if the school the student sort of requests it. If any time that you have a voluntary book voucher system that allows a student to have their a stipend sent to the bookstore, that's fine. That would not be considered an institutional charge as long as you can otherwise demonstrate that there's a real and reasonable opportunity for the student to get those books elsewhere. So in most cases, if you have a voucher program, it's probably not going to be, it's not going to cause you to put your books and supplies into the institutional charges category. So we've also gotten some questions about whether, in cases where a school owns is owned by a company that also owns a product line, in what circumstances would that product line be considered something that's unaffiliated with the school? And essentially, as long as the products are widely available on the retail market, so a lot of times these are cosmetology products when a cosmetology company is running a school. As long as those products are widely available and they're available to the public, even if the school is owned by the same entity that produces those products, we don't consider nationally distributed merchandise to be something that would cause the materials to be institutional charges. We say that a student does have a real and reasonable opportunity to purchase those somewhere other than the school in those cases. So those would not be considered institutional charges in the vast majority of cases. And this was something that we described in our electronic announcement that we published back in March on this topic. So the final category, excludable charges. So there are a very small number of things that we call excludable, and this actually only has application to the return of Title IV process. So excludable charges are charges that an institution can exclude from the RTT4 calculation, and there are really only three types of these. An administrative fee up to $100 or 5% of total institutional charges, whichever is less. The documented cost, and that's the cost of the institution, not the student. The cost that whatever it costs the school to purchase these materials of non-returnable equipment, and the documented cost of returnable equipment if the student doesn't return it within 20 days of withdrawing. So these are cases where you are requiring the student to buy the materials from you. You have required them to, they are institutional charges because they don't have a real and reasonable opportunity to purchase them elsewhere. However, you have spent some money up front purchasing those materials wholesale, and you've provided them to the student and by charging them. So if the student withdraws, the school is going to be left with, in some cases, left with that charge that hasn't been prorated out throughout the period. So we allow you to exclude some of whatever you paid, you as the school paid for the materials, from the RTT4 calculation. And I'll explain how that works in just a second. So, and this is what I was getting at just a second ago, documented costs are the cost to you, the institution, not to the student. So this is an important consideration. As an example, imagine a case where you, the school, spent $1,000 to purchase a kit wholesale from a provider, and then you charge a student $1,500 for the same kit. If that student begins attendance and then withdraws, and when you're working on their RTT4 calculation, you will ultimately include the $1,500 as an institutional charge, but you can exclude the $1,000 that you, the institution, paid wholesale for that kit. And that'll help reduce the amount that the institution is responsible for returning to the student who withdrew. And this is a little bit of an explanation about how this works. The institutional charges category in the RTT4 calculation essentially limits the amount that an institution has to return when a student has unearned funds. So we have a little example up here that kind of demonstrates how this works. For RTT4 purposes, you can exclude the amount that you paid. So in this example, the school charged $2,000 tuition, the student $1,000 room, the student was living on campus, $500 board, and then they had $1,000 in books and supplies that the student didn't have a real and reasonable opportunity to purchase elsewhere. So that's a total of $4,500. However, the institution can document that it paid $500 for the materials that it provided to the student, so it can exclude that $500, resulting in total institutional charges of $4,000 in the RTT4 calculation. So this has been a little known provision about how RTT4 works that we hadn't gotten very many questions about until we published our March electronic announcement about institutional charges. And so we wanted to give an example about how this actually works in practice. One important note at the bottom right-hand portion of this screen, institutional charges used in the RTT4 calculation can never be less than 0. And believe it or not, we've gotten asked this question. So if you've spent a lot of money on your books and supplies for some reason, and you didn't charge very much for them, you can't make the institutional charges less than 0 in your RTT4 calculation, because that would have some strange impacts on the calculation itself. It'll only go down to 0. So there are some other requirements for books and supplies, and I want to be clear here that books and supplies, this is a requirement that applies in all cases, not just cases where the books and supplies are being treated as institutional charges. So an institution has to provide a way for a student to obtain required books and supplies by the 7th day of the payment period if, and this is when this applies, 10 days prior to the start of the period, the institution could disperse Title IV aid for the student, and the disbursements would have created a Title IV credit balance. So even though this is student-specific, technically, most of the time schools have just set up processes where students can use this if they want to. It's just a little easier to set up a process for students to obtain books and supplies that applies to everyone, rather than just to these Title IV recipients who happen to have a credit balance or who would have a credit balance at the beginning of the period. But this is technically the rule. You only have to do this for students who you could disperse funds to, and if you did disperse 10 days prior to the payment period, that would have created a Title IV credit balance. So the amount that you have to provide is the lesser of the credit balance amount or the amount provided needed by the student for the books and supplies. So again, this is technically a student-specific rule, but you can apply this to everyone if you have a system for allowing students to obtain books and supplies that would just apply to everyone. One important thing, though, is that even if you have this policy, you do have to have a way for students to opt out of that method that you provide. And so you have to allow the student to get the books and supplies in some other way. And if you do that, you have to ensure that they're not being charged the same amount, that you're giving them the appropriate amount of Title IV credit balance funds to purchase the materials on their own, if indeed they are eligible for that. Now, if an institution meets certain conditions, you can also include the cost of books and supplies in your tuition and fees. However, because this essentially prevents students from purchasing those materials elsewhere, when you do that, we subject you to additional requirements. There's only a certain number of cases where you're allowed to include books and supplies in your tuition and fees. So the top line of this slide shows you a number of things that have to apply for most cases. Usually, you have to have an arrangement with a book publisher or other entity. The books and supplies that you make available as part of tuition need to be below competitive market rates, and you have to provide a way for students to opt out. And you also have to ensure that students can get the books and supplies at least by the 7th day of the payment period. So if you decide to include your books and supplies in tuition and fees, all of these things will have to apply, or there's two different options. You can demonstrate a compelling health or safety reason. So these are cases where the students have to have a specific kind of material in order to perform some dangerous activity that's part of your program, or the books and supplies are not available anywhere else. And this comes up most often when you have a professor that's requiring students to obtain a book or supply that they've written that is only available through the school. And a lot of times this also includes electronic materials where you're just charging tuition and the tuition includes access to electronic materials that are required for the program. Now, if books and supplies are institutional charges, they are always considered to be part of an institution's tuition and fees. So that's why institutional charges are so important here. If a student does not have a real and reasonable opportunity to obtain books and supplies, then their institutional charges, and therefore all of those things on the prior slide, will apply. So it's important for you to know whether students have the opportunity to purchase books and supplies elsewhere, from a place other than the institution. All right, and with that, I am going to turn it over to my co-presenter here, Greg Martin, to talk about crediting a student's account and go through some examples for you guys.
Thank you, and thanks, Dave, and welcome, everybody. We're going to begin by talking about crediting a student's account. And you can see here that an institution may credit a student's ledger account with Title IV funds payable for allowable charges associated with the current payment period. So we say you can charge students' account for allowable charges. Let's look at what those allowable charges are. Allowable charges always include tuition fees, institutionally provided room and board, and all other institutional charges. Books, supplies, and other educationally related goods and services provided by the institution that are not institutional charges, but for which the institution has obtained authorization from the student or parent. So for most of you, or many of you here in a more traditional environment, you're going to be looking at your tuition and fees and provided room and board being your institutional charges. And if you have the, you have a bookstore at which students can obtain books and supplies, but there is a real and reasonable opportunity to purchase elsewhere, those would be non-institutional charges. And in order for students to use their aid to pay for those charges, you have to have a student authorization allowing that to occur, or in the case of a PLUS loan, a parental authorization. Do I have the clicker, Dave?
Here. That'll be easier. There you go.
Hopefully I can. Green button, that's easy enough, right? Should be. Okay. All institutional charges are considered allowable charges. So basically, we're talking about allowable charges. You're just talking about those charges for which Title IV aid may be credited to a student's account to cover. A school may charge a student's account for institutional charges without authorization by the student or parent. So the tuition and fees and the room and board provided by the school are charges for which you do not have to obtain a separate authorization to charge. You must obtain an authorization from the student or parent in order to credit the account for other non-institutionally related educational charges. And this is probably something you're all doing. I just want to make, hopefully you're all doing it, and I do want to point out again that you only need to obtain an authorization one time for the student's matriculation at your institution. So obtain it when the student's a freshman is good through the point at which he or she graduates, unless he or she rescinds it. So that's, you don't need to go out and do it every year. So I just want to point that out. Come on. Okay. Am I doing something wrong? I swear to God, I pressed that green button. But I'm one of the kind of people that in restrooms with the automatic sink, no matter how long I hold my hands into there, the darn thing never works. Somebody else comes along and it comes on. I can't. It's inexplicable. It's something. It's not me though. I do everything correctly. Okay. A school is permitted to charge a student for the tuition, for the total tuition and fee cost for a program at the beginning of the first payment period of enrollment. However, this is going to have some effects on the Title IV award. So, institutions charge in different ways, and we don't dictate how you do that. You can charge either by the payment period, or you could charge up front for the entirety of the program, and that's up to you. But if you do charge for total tuition and fees for a program at the beginning, there are going to be some ramifications. If the program is longer than an academic year in length, for direct loans and campus-based, the tuition costs only apply to the first period of enrollment. So, an example would be a program of 1,500 clock hours in length, and you're going to charge up front for the entire program. And so when you look at that loan period, all the charges for the program, all of the tuition and fees are occurring in that first loan period. So in the second loan period, for the remaining 600 hours, you may not include any tuition and fee charges for that, just you could have other cost of attendance elements, such as living expenses, transportation, that type of thing. Well, try it again here. I don't know why I'm so impaired, but that's just the way it is. Okay, let's talk about prior year charges. Allowable charges also include prior year charges. So we do have, I know a lot of schools don't like the limitation on this, but I would point out that this is a very, we really took a stretch here, because if you look at what the statute says, technically Title IV should only go for current year charges. That's basically the statement of ed purpose and what Title IV is intended to do. So, but we do realize that there are some charges that are existing from a prior time, and we tried to accommodate some of that. So a school can only credit up to $200 in prior year charges. And for purposes of determining what a prior year charge is, the current year is, for the student who receives only a direct loan, the current loan period. If the student does not receive a direct loan but receives other Title IV funds, it's the current award year, or for a student who receives both types of aid, the current loan period or the current award year at the school's discretion. So that determines what that current year is going to be for purposes of determining whether or not you have prior year charges. Okay, Dave. See, I told you so. All right, there you go. All right, that's fine. Maybe the batteries are starting to go. That could be. Let's talk a little bit about Title IV credit balances. And so when we talk about credit balances, for purposes of our programs, we're only concerned with Title IV credit balances. So it's important that when you look at what constitutes a Title IV credit balance, that can be different from a regular credit balance. So let's take a look at that here. A Title IV credit balance occurs whenever the amount of Title IV funds credited to the student's account for a payment period exceed the amount assessed the student for allowable charges associated with that payment period. So it's Title IV funds exceed the allowable charges. We have an example here. In this example, Title IV funds credited do exceed the allowable charges assessed by the institution. You can see here we have $3,000 in allowable charges. We have credits to the student's account of $6,172, but note what the breakdown of those credits are. We have Pell of $1,900, direct loan of $3,272, and a scholarship, which is not Title IV funds, right? So that would not be included in determining the Title IV credit balance. So you can see here that the Title IV credit balance, when it's determined, is not inclusive of that scholarship, only Title IV funds, and the Title IV credit balance is $2,172. So that would be the amount that you're obligated to alleviate or give to the student according to our rules. It's probably easiest just to treat all credit balance the same way that federal rules require you to treat Title IV credit balances, and you can certainly do that, but the only credit balances you're obligated to get back to the student within the requisite 14 days would be Title IV credit balances. If there's no authorization on that you have on account to on file rather to hold credit balance funds, the school must pay the credit balance funds to the student or parent, and we do have some rules here which go way back, so you're probably familiar with these. 14 calendar days, no later than rather, 14 calendar days after the balance occurs, if it occurs after the first day of the payment period, or 14 calendar days after the first day of classes, if it occurs on or before the first day of classes for the payment period. And you're not required to pay credit balances below $1. A student or a parent can authorize the school to hold credit balance if he or she wants to, and you offer that that option. You don't have to do it, but some schools do want to offer the option to hold credit balances. It can help to budget a student's funds throughout the payment period. You may, depending upon your student body, you may have some students for whom it's not a good idea necessarily for them to get all the funds up front, although they can if they want to. Maybe they want them budgeted. A student or parent may authorize this to hold the student or parent's credit balance with an authorization. There are some rules here. You must identify the amount of funds held for each student in a separate subsidiary ledger account, and you must maintain a cash balance equal to that amount at all times. I like to refer to it as if there were a theoretical run on the bank and every student for whom you had this authorization came in and said, I want my balance now, it probably wouldn't happen, but if they did, you would have enough money to pay it all back to them. The school may retain interest on the credit balance funds held by the school with authorization. And again, it's not required that you do this. Let's talk about prorating charges by payment period. If a school assesses institutional charges for a period of time that is longer than a payment period, you have to prorate the amount of allowable charges for which the institution is permitted to credit the student's account without an explicit authorization. And the school can do this in one of two ways. If you have payment periods for which the charge is assessed which are substantially equal, you would do it by dividing the institutional charges by the number of payment periods to which the charges are assessed. So if you're charging up front for the entire program, then you're looking at dividing those charges over the total number of payment periods in the entire program, if they're equal. If the payment periods for which the charge is assessed are not substantially equal, you would do it by dividing the number of creditor clock hours in the current payment period by the total number of creditor clock hours in the period for which charges are assessed and multiplying that result by the amount of the charge. So you actually do an equal proration if they're not equal, if those payment periods are not equal. And you know, just a little bit about the history of this. The reason for which we require this is if you are charging up front for a program, is charging the entire amount of the program up front, we want to make certain that students have a way of getting a credit balance for living expenses. And if we didn't require the proration, then it would probably be the result would probably be, rather, that a student wouldn't get a credit balance until late in the program because all of those charges have been front-loaded. And remember that tuition and fees is not the only component of the cost of attendance for which the student is receiving aid. Okay, let's talk about prorating payment period, books and supplies. If books and supplies are considered institutional charges, they must be considered part of tuition and fees. So let's go back to initially when David was talking about what constitutes these institutional charges and what's going to constitute non-institutional charges. So the books and supplies can only be a non-institutional charge if there's a real and reasonable opportunity for the student to purchase elsewhere. If that's not the case, then those books are necessarily, or in supplies, are necessarily going to be institutional charges, and they must be considered part of tuition and fees. And because of that, the charges must be prorated if they're intended for use for longer than a payment period. So in a lot of programs for which students are charged up front, they receive maybe a kit, books and supplies. They're going to be used throughout the entirety of the program, not just for one payment period. So because they're applicable to the entire program, or more than just the payment period, is the way of saying that correctly, and they are considered institutional charges, proration is necessary. Books and supplies are institutional charges if a student does not have a real and reasonable opportunity to purchase elsewhere. And that is the key element of this that you want to remember. So it would do well to repeat that as often as possible. As David pointed out, we do have a couple examples here to try to tie in all of this, what we've just talked about, and see how it works out in some actual with some actual numbers. So let's take a look at this. We have a school that charges $4,000 for each academic year in a standard term credit hour program. And the terms are 15 weeks in length, and the students are charged once at the beginning of each term. So this is a pretty standard way of doing things. The charge is for each term. The $4,000 charge is prorated between the fall and spring by dividing the charge in half because the two terms are substantially equal. The school has incorporated the cost of books and supplies into its tuition. So here we have an example where the books and supplies, there's no real and reasonable opportunity to purchase elsewhere. It's incorporated into the tuition. The student receives a $2,500 Pell Grant disbursement for the fall term. Because there are only $2,000 in allowable charges for the fall term, this creates a $500 Title IV credit balance. So remember here that the school has charged $4,000 for each academic year. So they've charged for the whole academic year, right? So because of that, the charges are for more than a payment period. We've required them to prorate those charges down. So they're only allowed for purposes of determining the credit balance to use $2,000. The allowable charges are $2,000 for each term. So the student receives $2,500 in Pell Grant disbursement for the fall, but there are only $2,000 in allowable charges. This creates a $500 credit balance, and the school provides the student with a $500 credit balance within 14 days of the disbursement. So even though the school has charged $4,000, they've charged the student $4,000 for the academic year, because that amount is for more than a term, they're going to have to do the proration, and you can see how this works out here. It enables the student to get a credit balance for living expenses, whereas otherwise the student would not have received that credit balance disbursement. So for the fall term here, you have tuition and fees total for $4,000 fall and spring. Prorated charges are $2,000. The Pell Grant is $2,500. That gives us a credit balance of $500 in each case. Let's move on to example number 2. Here we have a school offering a 1 academic year non-term program that comprises 24 credit hours and 30 weeks of instruction. So a fairly straightforward non-term credit program here. The school charges total tuition of $12,000 for the program. However, in this case, the school does not charge the full amount up front. So even though this is a non-term credit hour program, and frequently schools do charge up front for such programs, in this case, the school's not going to do that. The school actually charges $7,000 at the beginning of the first payment period and $5,000 when the student begins the second payment period. So they're actually charging for tuition and fees, the actual charges that are associated with each payment period. All students in the program receive a laptop and books and supplies on the first day of classes, and the school requires all students to pay $2,000 up front for those materials. So here we have a sort of a mixture. The tuition and fees are not being charged up front, right? They're being charged by payment period, and they're the actual charges for those payment periods. However, the $2,000 for books and supplies is being charged up front. Because the school cannot document in this case that students have a real and reasonable opportunity to purchase the kit elsewhere, the cost of the kit must be prorated over the 2 payment periods in the program. And to prorate the charge, the institution divides it in half because the 2 payment periods it covers are substantially equal. So let's look at the way this works out in the graphic here that David's done. We have payment period 1, and we know the school charged $7,000 in tuition and fees for that payment period. You see that represented there. And then you see the charges for payment period 2. We're not going to prorate those charges because those are actual charges and they're only for that particular term. So those aren't subject to proration. However, the books and supplies are, because they're being charged up front for the entirety of our program. Okay, let's go to the next page there. Yeah, that's good, Dave, right there. A student is awarded, let's take a look at the student's award now for this same example. The student is awarded $3,500 in direct subsidized loan, and they get a $6,000 unsubsidized direct loan, and they get a $4,500 Pell Grant. The student receives a total of $7,000 in disbursements of Title IV aid for each payment period, and the school determines allowable charges are $8,000 for payment period 1. And that includes the $7,000 of tuition we talked about that wasn't prorated, right? Plus the kit charge, which we have to prorate here. So the kit charge was $2,000. We're prorating $1,000 into that first payment period for a total allowable charges of $8,000 for payment period number 1. And then when we do the same thing for payment period number 2, we're going to take the $5,000 in charges for payment period number 2, add in the $1,000 of prorated kit charges, and we have total charges of $6,000 for payment period number 2. There's no credit balance during payment period number 1, and the student has to pay $1,000 out of pocket because there's a balance due. And if we look at payment period number 2, however, because the charges were less, we actually have a $1,000 credit balance, which occurs at that time, and the school must pay that credit balance within 14 days. So what we wanted to show you here was an example of tuition and fees didn't need to be prorated, but there were other charges that were for the entirety of the program, or not just applicable to one given payment period. Therefore, those charges were required to be prorated. We have one final example here. Let's take a look at that. We now have a school offering a clock hour program. And this includes 1,500 clock hours offered over 50 weeks of instructional time. The school, in this case, does charge $13,000 for the program up front, which must be prorated over all the payment periods in the program, and the school defines the academic year for the program as 900 hours and 26 weeks of instructional time. Remember that for a clock hour program, the minimum number of weeks is not 30, but 26 in the definition of an academic year. The payment periods for the program are structured as follows. Let's take a look at those. Academic year 1, we're required to divide that into 2 equal payment periods, 450 and 450. And we have a remaining 600 hours left in academic year 2, and we have 2 subsequent payment periods of 300 hours each. Now let's take a look at the kit charge. The school includes a $2,000 charge for the required kit in the student's enrollment agreement. And this is typical with programs like this. You have an enrollment agreement where we have a tuition and fee charge, and the cost for books and supplies is rolled up into that charge as part of the enrollment agreement the student signs. So this is definitely an example of where the tuition and fees, where the books and supplies, rather, are part of tuition and fees. Students are not allowed to enroll in this program without purchasing the kit from the school. So the school is not giving the student any other opportunities. It must be purchased from the institution. Therefore, the school cannot demonstrate that the students have a real and reasonable opportunity to purchase elsewhere. In this case, the school is saying you must purchase from us. Therefore, that real and reasonable opportunity cannot be said to exist. The charges for the kit are considered institutional charges and must be prorated over the payment periods in the program the same way as tuition and fees must be. So unlike the previous example where we were not prorating tuition and fees but were prorating the kit, in this case the kit is part of tuition and fees, and both tuition and fees and the kit have been charged for the entire period. Tuition and fees are $13,000 plus books and supplies $2,000, giving us $15,000 for the entire program. Now, when we actually look at the proration here, we're now looking at payment periods that aren't substantially equal, that are not substantially equal. Remember, in the previous example, it was easy. We had just 2 payment periods divided in half. Here we don't. Because of that, the institution has to prorate the institutional charges for each of the payment periods by dividing the hours in the period by the total number of hours in the program and multiplying that result by the total institutional charges for the program. And you can see how that's been done here. Hours in the program are 450. Hours in payment period number 1 are 450, divided by the number of hours in the program, 1,500, giving us 0.3. And program charges of $15,000 are multiplied by that amount, and you can see here that that winds up being $4,500. We do the same thing for payment period number 2, and then we move down to the second award year. So we have payment period 1 for award year 1, payment period 2 for award year 1. Now we move down to payment period 1 for award year 2, and we see that we have hours in the payment period are 300 divided by 1,500, giving us 20% of the program, and we're multiplying 15,000 by that, giving us 3,000, and the same calculation done for the second payment period of award year 2. So this is how you would do it for payment periods that are not substantially equal. The institution charged for full tuition at the beginning of the first payment period. Because of that, all of those costs for tuition are going to be included for direct loan purposes. Those all fall into the first year. So we look at the cost of attendance then. And remember, you have differences in the way you do cost of attendance for Pell and for direct loan, right? But for direct loan and campus-based, the cost of attendance that you look at when you are I always want to say certifying a loan, and that's incorrect. It shows how old I am. When you are, thank you. I'm still stuck back in 1991. When you're originating, it was a very good year, by the way, when you're originating loans, okay? So that would be the loan charges that are associated with that year. The actual charges associated with that year. And in this case, that's $22,000 because you charged everything up front. You can see in academic year 2 here The only charges we have are $5,000 of cost of attendance charges, and those would be charges that would be related to the cost of attendance, other elements of the cost of attendance that are not tuition and fees. So basically, in a nutshell, living expenses. Tuition fees, books and supplies charge is $15,000 for the entire program, and the total cost of attendance for academic year 1 is $22,000, and this includes tuition fees, books and supplies of $15,000, plus living expenses that are for that year as well. The cost of attendance for academic year 2 is only going to be $5,000 because what kind of tuition and fees cannot be used in that year and for that loan because they were charged up front. So the only charges that exist here are those $5,000 that are living expenses. Let's take a look at the proration and take a look at the aid. In the first academic year, the student receives the following Title IV aid. We have a Pell Grant of $5,100. We've got a subsidized direct loan of $3,500 and an unsubsidized direct loan of $2,000. The school determines that the student will receive Title IV disbursements totaling $5,300 in both payment period 1 and 2, and is going to have an $800 credit balance in both of those payment periods because we're prorating those charges out. The school provides the student with refunds within the 14 days required. Here we can see we have tuition and fees, books and supplies of $15,000 for the entire program. They were charged up front. We're going to have to prorate those charges for purposes of determining the credit balance. And we have prorated tuition and fees of $4,500 and Title IV aid of $5,300, giving us that Title IV credit balance of $800 in each of those payment periods associated with that first academic year. Let's go to the second academic year. In the second academic year, the student receives the following Title IV aid. Pell Grant, $3,400, subsidized direct loan of $1,600. So we note that those amounts, if we go just in going back before, that previously the subsidized loan was $3,500, and now it's only going to be $16,000. The Pell Grant was $51,000, but it's $34,000 because that has to be prorated for the number of hours in the payment period. And we only have 600 hours remaining in the final academic year. The school cannot award direct loan funds exceeding $1,600 because the total direct loan cost of attendance for the academic year is only $5,000. The school must subtract the $3,400 in Pell funds as estimated financial assistance. So we have tuition fees, books and supplies of $15,000 for the entire program. And let's take a look at award year 2, payment period 1. We have prorated tuition and fees of $3,000 minus total Title IV aid of $2,500. In this case, because the charges are less, or rather the aid is less, I should say, we don't have a credit balance. In fact, the student actually owes a balance to the institution of $500, and that occurs in each payment period. So just showing you how this plays out in actuality. Because the student is receiving a much smaller amount of Title IV aid this year, she only receives disbursement of $2,500. The total Title IV aid the student will receive in each payment period is going to exceed those allowable charges. Just kind of a repeat of the last slide, just explaining it here, why the student will not be receiving a credit balance in academic year 2. Now we're going to move on to looking at this example in terms of an R2T4 calculation if the student withdrew. So what we have here are these, this exclamatory sentence here, but wait, our student has unfortunately withdrawn. What would happen if the student withdrew in the first payment period of this program? How would the student's institutional charges be determined? Because that has to be done in step 5 of the in the calculation. The institution is going to add up the prorated charges for the payment period. And next, the institution would then subtract the total amount of excludable costs, that is the amount spent on the unreturnable kit, from the total in step 1. The total prorated charges for the first payment period were $4,500. And the school spent a total of $1,000 on the kit prior to the student's enrollment. That's the actual cost of the kit to the school. Therefore, the total institutional charges used in the R2T4 calculation are going to be $3,500. So you can reduce those institutional charges by the excludable portion of the kit, in this case because it's of the non-returnable kit. So in this case, it's $1,000. Total institutional charges then are reduced by that amount down to $3,500. And that's to the benefit of the school in the R2T4 calculation. Finally, we have some resources for you here. We've got a January 1999 policy bulletin on calculating institutional refunds, which goes into some detail about what constitutes institutional charges. So this is basically the guidance that we've used since that point of time for determining what constitutes institutional charges. The March 5th electronic announcement does make some tweaks to that, but it doesn't totally obviate that policy bulletin, which is really still where we go for making those, where the philosophy behind institutional charges is laid out. We have a December 2000 Dear Colleague letter, Gen 0024 on R2T4. We've got a November 28, 2012 Dear Colleague letter, Gen 1221 on using Title IV funds to pay for charges at a bookstore. And our most recent guidance would be our March 5th, 2019 electronic announcement on which a lot of this is based, which provided more latitude to institutions than perhaps would be inferred from reading the regulations. So you definitely want to take a look at that March 5th, 2019 guidance. And we also give you the applicable handbook citations for that as well. We do have 20 minutes left, so we would like to entertain any questions that you have. We ask that you approach the microphones to ask those questions. So please feel free to come up, and we do have a fair amount of time, which is a good thing, to clear up any areas that you might still have some confusion on. Thank you.
So we'll start with over on number 1.
Good morning.
Morning.
Just a question, clarification on the 14-day time period, calendar days to return a credit balance. Is day 1 the day that the Title IV funds come in and create the credit, or is it the next day when the clock starts for the 14 days?
Good question. It starts on the next day. So the next day, Title IV credit balance is created. The next day is day 1, 2, 3, 4, 14.
Perfect. Thank you.
Mm-hmm.
Good morning. Regarding parking fines, I understand they're a non-institutional charge. For parking permits and school-subsidized bus passes, would those be both considered institutional charges?
So are all students required to have those?
No.
Generally speaking, we would not consider them to be institutional charges in that case, if the student can choose whether they want to obtain those.
Okay. So you're saying parking permits for students, even though the majority of them get them, those are not institutional charges? Okay.
And remember, you would just, as long as you have the student's authorization to charge the account, to use Title IV funds to pay for those charges, you're fine. Student wants to purchase a parking pass, you could use Title IV funds to pay for that.
Okay, thank you.
So we're looking at doing an all-inclusive model. So one flat fee, which would be tuition and books or whatever consumables within the same cost. So the dollar value we would come to, we've not quite got to the formula, would be a formulated dollar amount. So it wouldn't be an exact dollar amount for what we paid for the book. So when I do my R2T4 and I do that in exclusion part, would I exclude the actual amount we paid for the book, or would I exclude that formulated amount that we used to add to the tuition?
It's the former. It's the amount that you, the institution, paid for the materials, not the prorated cost to the student.
Okay.
It's what you guys paid, not what the student paid.
Okay, one other real quick. So we have some other courses where we do have some consumable fees. The consumable fees actually equate to equipment. For example, in welding, we have a consumable fee for welding rods. So I'm able to back out our costs for those welding rods when I do R2T4 as an exclusion.
So these were cases where, yeah, you guys paid for those. They go to the student. The student does not return them. They can't be returned.
They might be able to be returned, but if they're not,
So these are returnable, but if the student doesn't return them within 20 days, then yes, you could exclude the amount that you, the institution, paid for those materials from the institutional charges in the RT4 calculation.
All right, great, thank you.
Sure.
If a check kit is being charged and they need it for the program, but they have an opportunity to buy it anywhere else, if there's a small percentage, and doesn't matter how big or small, that has to use Title IV funding to do it, does that negate the...
No. But if you're talking about whether a charge is an institutional charge or not, as long as a real and reasonable opportunity exists for the students to purchase it elsewhere, we don't care how many students actually do purchase it elsewhere. It could be that none of the students choose to do that, and it doesn't matter whether or not, whether Title IV aid paid for it to be purchased elsewhere wouldn't be germane.
Okay, thank you.
Registry and licensure fees, can be considered institutional charge?
Yeah, exactly what type of fees are we talking about here?
Like nursing licensure, examination fees, and registry fees?
Yeah, they can be included in the cost of attendance.
So is that something that you are sort of collecting from the student and then simply sending on to the state?
Yes.
In that case, we consider that to be a sort of pass-through charge. So you're not charging it as the institution, you're simply collecting it on the student's behalf and giving it to another entity entirely that you're unaffiliated with. I mean, you have an affiliation with the state, but that's not who you, the institution, are. So that's not an institutional charge for your purposes.
Okay.
Those fees would go, because they're going to the state and not to you, the institution, that's not an institutional charge.
Okay, so we can't use Title IV funds even if they...
You can use the Title IV funds to pay for those fees, but they're not institutional charges per se. You just have to have the student's authorization to pay for them.
Okay, and then one more other question. Credit card, like convenience fees.
Those are we would consider those to be discretionary, and those are not institutional charges.
Okay, so we need the authorization to use Title IV funds.
Correct.
Thank you.
Number 3.
Okay, my first question is in regards to the exclusion. Would that only really apply if there was no return to Title IV to the department? So if the student has earned all of their aid and they've completed the 60% threshold, then I guess we wouldn't have a return.
It won't matter.
It won't matter. Okay.
None of those will matter for Title IV purposes.
Okay, so we would only do that exclusion calculation if it's less than 60% of the payment period.
So this is an RT4 question, but I want to be clear. So technically, if the student gets beyond 60%, you do have to document that the student received all the aid for which they were eligible, and you have to show that they completed 60%. But essentially, yes, you don't have to do the RT4 calculation at that point.
And then my next question would be in regards to athletics. We have a athletic program. We partnered with another entity that manages it for us. Could we allow the student with their authorization to use their aid to pay for their athletic fee registration?
So
or is it only allowed if it's athletics for the school?
So I think we may not know enough about how the affiliation works with the company. So is your institution sort of working with the company and receiving some of that revenue, or is it just the students just pay this other company for their athletic facilities? And
well, we have a sports team, so we have a football team, but
okay.
It's not a collegiate football team. It's a preparatory or a booster club or a club team. So there's a registration fee to participate for that team, and it's sponsored by the school.
Okay, and so, but it's still discretionary. The students don't have to join the team.
They don't have to, but
that.
If we have authorization from the student to pay the $500 fee, could they use their Title IV aid to pay for it?
So that's educationally related, and it's not an institutional charge. So in order to pay for that fee with Title IV aid. You just have to have the student's authorization to do that.
Okay, and
that would
can
be
they
fine.
use their aid to pay for their equipment? So if they need tennis shoes and they need a uniform or helmet, shoulder pads,
So
can they use their Title IV aid to pay for that as well?
In general, the department considers athletic activities related to the student's college experience to be educationally related activities. So yes, those are things, as long as you have their authorization, that you can pay for with Title IV aid.
Okay, thank you.
Good morning. My question is related to the student authorization issue. So, do I have to have a student authorization to give a student a voucher for the bookstore since it's not a direct charge, or can I just give them the voucher?
So with respect to vouchers, you know, if a voucher is if a book voucher is required, if you require students to purchase a book voucher from you, then that is an institutional charge. If book vouchers are optional, then they are a non-institutional charge, and you can offer the student the option of, if that's the way they're going to pay for books and supplies at the bookstore by using a voucher, then yes, that would be a non-institutional charge, and it's not tuition and fees, it's not room and board, so therefore you'd have to have an authorization from the student in order to use his or her Title IV funds to pay for that book voucher.
Okay, so any student can come and get it if they have a credit balance available.
Well, yeah, presumably any student could come and get, if they have a credit balance, you could have their aid, if they have aid to pay for it, their Title IV aid could pay for it as long as they've got an authorization allowing you to do that.
Okay.
Sure.
Thank you very much.
Sure.
Hi. We have a clock hour culinary program for unequal payment periods. We do not charge the tuition and fees or the program fee up front. They're broken down by payment period. But we have a $1,500, which is actually the cost, nothing added to it, kit. And that kit is non-returnable. It has knives and things, books, obviously, and others. It is charged all up front for that first payment period, traditionally. Well, that's when it's charged. I understand that we have to prorate that kit. I think it's $375 per payment period. My question is, what happens if the student simply doesn't return? It's not an R2T4 situation, I don't believe. If I come to the first payment period and then decide I hate cooking for other people, I'm not coming back, we are out because we fronted the cost of that kit, $1,500. To date, we've only assessed the student $375. Do we have any way to recoup those funds legally?
So, I mean, for Title IV purposes, that is exactly right. Unfortunately, in those cases, the school will have paid more than it received from the student in Title IV funds. Obviously, we don't restrict how you deal with that situation. You can, hold the student responsible for the costs of the kit that he or she didn't end up paying for. But it's not something that they'll be able to pay for with the Title IV aid that they got. That was credited to the student's account.
Mm-hmm.
If the student wants to take the aid that he or she got as a credit balance and come back and pay for that, they can. But
Assuming they
that's
have
not
it.
something that and that probably doesn't happen that often. But yes, that is all correct.
But we are allowed to basically to say this is still a remaining cost
Oh,
to the
absolutely.
student.
That's your-
You're not
that's your
getting a
cost.
transcript. Well, I don't know why they'd want a transcript.
Yeah, I
anyway.
mean, one thing I want to remind everybody of, and this may or may not work for you, but it is an option, So because we've even gone so far as to say that you can even include a kit in enrollment agreement and say, you have to have this kit. If you wanted the kit to be a non-institutional charge, as long as there was a real and reasonable opportunity for the student to purchase it elsewhere, if you could find a place that they could purchase it, even if they choose to purchase it from you, you could even include in the enrollment agreement that you must purchase this kit prior to beginning classes. It's mandatory, whether you get it from this other source or us. And then the student could just say, as long as you don't charge for it up front, you say the student has to indicate somewhere, I want to buy it from the school. Yes, I want to buy it from you. You get the authorization from the student. And the advantage of that over what you just described would be you could use any of the student's Title IV aid to pay for that kit initially. Because it's a non-institutional charge, it wouldn't have to be prorated. So, if you're able to find it, now I understand there are some situations where schools might say, well, there really is no other opportunity anywhere else, and we just, or we want the control of having the student buy this kit. But if you're offering that kit, below market value, and I would say probably overwhelming majority of your students are going to purchase the kit from you. And if that's the case, you may want to consider going in that direction to avoid what you've just outlined here.
Okay, thank you.
Hello. I don't even know if it's morning or afternoon, so hello.
We don't. Yeah, we don't either.
I think I know the answer to this, but late fees to a student account, a student doesn't get their financial aid, doesn't apply for it till late in the semester when they get late fees already applied. We need an authorization to pay the late fees out of there along with the tuition and fees.
Yeah, we have already determined that late fees, any kind of penalty fees like that, are not even allowable charges. You can't use Title IV aid to assess a student a late charge.
Even with the authorization?
Even with the student's authorization, right. Bad check fees is another example of something you may not use Title IV aid for. Overall punitive fees, we do make an exception, and it may seem a little inconsistent, but we do make an exception for minor things like library charges, parking fees. But overall, late charges associated with a program are not really, they're not part of the tuition and fee aspect of that program. It's basically a penalty.
Okay. I have another quick question. On page 17 of your PowerPoint, it states that the requirement to release credit balance, or excuse me, it seems to contradict the requirement to release the credit balance within 14 days. On 17, it says if they're eligible, you have to do within 7th day of it. Well, that's contradicting the 14-day.
Well, so it's not exactly contradicting, but I certainly understand how it's confusing. So remember that this isn't exactly the same as actually providing the credit balance to the student. This is about getting the books and supplies to the student. Now, I know that a lot of times that's simply done by providing the credit balance to the student and ensuring that they have access to get those books. But what this is saying is that if the student is going to have a Title IV credit balance, that you need to make sure that they have those books and supplies in hand by the 7th day of the period. So the reason it's stated this way is that technically you don't have to make your disbursement at the beginning of the payment period. You might make your disbursement to the student in the middle of the payment period. And if you did that, then they wouldn't have a credit balance at all until that middle of the payment period, and the 14 days wouldn't start ticking until the middle of the payment period. But how did that student get access to their books and supplies? That's why this is structured in the way that it is, to say, if you could have made that disbursement to the student 10 days prior to the payment period, then you need to make sure that they have access to the books somehow, so that they can just get their materials and they can start their coursework.
So we don't offer, we have a bookstore, but it's independently owned, so we don't have book charges coming in. So in that case, we would have to make sure the 7 days trumps the 14 days in that situation.
That's correct.
And then one more. Intersession, we have a winter intersession we've attached to spring. So anyone that's in that, we've discovered, we interpreted the rules that we have to provide them books for that before the intersession. We don't want to give them their whole credit balance back at the beginning of December. They'd have a fun Christmas, just thinking. But so we've provided an option to opt in, not to opt out, is to opt in to get a bookstore voucher, because then they say, yes, I need the bookstore voucher to get my books. Otherwise, they wait to get their credit balance in the spring.
No, I mean, I think, yeah, if you've attached an intersession to a term, and then yeah, the obligation would be, if a student's taking courses, you've got to make those books available to them 7 days of when they start those classes in that intersession.
Okay.
So,
But I would say that an opt-in is also acceptable as opposed to an opt-out. You know, as long as they have the option available to them, that's the requirement.
Right.
we're going to have to limit everybody to one question. We only got about 4 minutes left, so one question apiece, and only those who are in line currently.
So I have a question on the return to Title IV exclusion. For rental books, we are now finding that students are not returning their rentals. And so can we exclude the cost of the rental that they do not return?
It is, yeah. So yes, I think we would say that if they now, generally speaking, these are referring to things that have to be returned. So these are rentals that have to be returned. I just want to make that clarification because sometimes students buy used books, it's theirs, they don't ever, it's not really something that has to be returned. But if it has to be returned and it is returnable and they don't return it, then if you, the institution, have paid for it, then you can exclude the amount that you, the institution, paid for those books.
Yes, this is a situation where the student has provided a credit card as security on that rental, and then they have not returned it. Our bookstore has went to charge that credit card. It's no longer a valid credit card, or the transaction does not go through. And now this seems like a viable option that we could exclude that. Instead of returning those funds, we could actually recoup the cost of that rental instead of taking the loss.
And I was gonna, Greg is making the same point that I was thinking of. That, I mean, it will affect the amount that you end up returning for the withdrawn student, but it won't. It probably isn't going to help you recoup the entire amount because it's only going to be whatever the change is to the institutional charges in the calculation. But it may help.
It could
limit the amount that you guys have to return.
Right, especially because we front the money. And then, so we're collecting it both ways.
Yeah, no, I mean, that you've described a situation, that falls right into the excludable charge category.
Thank you.
Yeah.
Let's go over to Mike 3.
Last question on Mike 3.
On reasonable opportunity. So we have a voluntary book voucher program. However, our students that are using it is because they don't have a way to buy the books anywhere else. Like, yes, they could go somewhere and buy them, but they financially don't have a way.
Right.
So it just seems like this kind of has a negative impact on those students.
No, the real and reasonable opportunity means the reasonable opportunity exists. If it wouldn't be that if the student can't buy, if it's the student can't, the student's finances are not a consideration in that. I mean, if they say that because of finance situations they would rather buy it from the school, that doesn't mean they weren't reasonably available elsewhere. Just because it was more convenient for the student or fit the student's resources. So you're fine.
Okay, thank you.
We'll do one.
As far as health insurance goes, we mandate every student has it, and it does apply if they withdraw. So we can include that as an institutional charge in the R2T4.
That's a non-institutional charge.
Sorry, yeah.
So you would not include that in your R2T4 calculation, which would mean that you will have to return less for that student than you would otherwise.
Perfect. Thank you.
Yeah. Thank you. All right. And thank you all for coming and for participating today. If you have other questions, we can take a few of them up front, but we do have another session coming in about 20 minutes. But thank you so much.
Thank you.